September 15, 2008. A Monday morning that would change the world forever. Lehman Brothers, a 158-year-old financial giant, had just declared bankruptcy. Within hours, stock markets around the world were in free fall. Retirement savings vanished. Banks stopped lending, and millions of ordinary people watched helplessly as their homes, their jobs, and their dreams simply disappeared. But here's the question nobody was asking. How did the richest country on earth come so close to complete financial collapse? And more importantly, who was responsible? Let's go back to where it all began. To understand the 2008 crisis, we need to go back to the early 2000s, when America was living a dream built on one simple idea. Everyone deserves to own a home. The government encouraged banks to give loans to more Americans. Interest rates were historically low, and suddenly, buying a house seemed easier than ever before. But here's where things started to go wrong. Banks realized they could make enormous profits by giving out home loans. The more loans they gave, the more money they made. So what did they do? They started giving loans to people who couldn't afford them. These were called subprime mortgages. People with bad credit, no stable income, sometimes no job at all, were suddenly approved for massive home loans. A cleaner earning $30,000 a year? Here's a loan for a $500,000 house. No proof of income, no problem. Sign here. Why would banks do something so reckless? Because they had discovered a way to make it someone else's problem. Banks didn't want to hold these risky loans themselves, so they invented something called mortgage-backed securities. Here's how it worked. Banks would bundle thousands of home loans together and sell them to investors as a single product. They told investors these products were safe. Rating agencies like Moody's and Standard & Poor's gave them their highest ratings, AAA, the same rating given to U.S. government bonds. Investors from around the world, pension funds, foreign banks, retirement accounts, everyone wanted a piece of this money machine. But wait, it gets worse. Wall Street then created something even more dangerous. Collateralized debt obligations, or CDOS. These were bundles of bundles. Layers upon layers of debt. So complicated that even the people selling them didn't fully understand what was inside. And then came the final ingredient of disaster. Credit default swaps. These were essentially insurance policies on these risky products. Companies like AIG sold trillions of dollars worth of this insurance, betting that the housing market would never crash. Everyone was making money. Bankers were getting million-dollar bonuses. Home prices kept rising. Nobody wanted to ask the obvious question: what happens when people can't pay back their loans? By 2006, the first cracks appeared. Interest rates started rising. Those cheap mortgages suddenly became expensive. Monthly payments doubled, sometimes tripled. Families who could barely afford their homes before now had no chance. Defaults began. First a few, then thousands, then millions. As people stopped paying, home prices started falling. For the first time in decades, houses were worth less than what people owed on them. Homeowners simply walked away, leaving banks with properties nobody wanted to buy. The mortgage-backed securities that Wall Street had sold as safe investments, they were now worthless. Banks around the world were holding trillions of dollars in toxic assets. In early 2008, Bear Stearns, one of America's largest investment banks, collapsed. The Federal Reserve arranged an emergency sale to J.P. Morgan Chase. But this was just the beginning. September 2008, the month that almost ended the global financial system. Lehman Brothers was drowning. They held billions in worthless mortgage securities. CEO Dick Fould desperately searched for a buyer, a bailout, anything. But this time, the government said no. On September 15th, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history. $600 billion in assets gone overnight. The next day, the stock market crashed. The Dow Jones fell 500 points. Banks stopped trusting each other. Lending froze completely. Then came the news about AIG. The insurance giant had sold so many credit default swaps that they owed more money than they could ever pay. If AIG failed, every major bank in the world would go down with it. This time, the government had no choice. They bailed out AIG with $85 billion. That number would eventually grow to over $180 billion. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke went to Congress with a terrifying message. Give us $700 billion or the entire economy will collapse. The first vote failed. The stock market dropped 700 points in a single day. The largest point drop in history. Congress voted again. This time, they passed the Emergency Economic Stabilization Act. The $700 billion bailout was approved. But for millions of ordinary Americans, the bailout came too late. Nearly 9 million people lost their jobs. Unemployment hit 10%. In some cities, it was much higher. Almost 4 million families lost their homes to foreclosure. Entire neighborhoods became ghost towns, filled with empty houses and overgrown lawns. Retirement accounts lost trillions in value. People who had worked their entire lives saw their savings cut in half. The crisis spread beyond America. Banks failed in the United Kingdom, Iceland, Ireland. Greece entered a debt crisis that would last for years. The entire global economy fell into the worst recession since the Great Depression. So who was to blame for this disaster? The banks, who gave loans to people they knew couldn't pay. The rating agencies who stamped toxic products as safe investments. The regulators who looked the other way while Wall Street gambled with the economy. The government, who pushed home ownership without considering the risks. The answer is all of them. But here's the part that still makes people angry. The banks that caused the crisis, they were bailed out with taxpayer money. The executives who made millions while their companies collapsed, most of them kept their bonuses. The number of Wall Street bankers who went to prison for their role in the crisis? One. Just one. Meanwhile, millions of ordinary families lost everything. The 2008 financial crisis taught us that the global economy is more connected and more fragile than we ever imagined. It showed us what happens when greed goes unchecked and regulations fail. New laws were passed. Banks are supposedly safer now. But some experts warn that we're making the same mistakes again. Debt levels are higher than ever. New financial products are being created. And the same institutions that failed us before are bigger than ever. The question isn't whether another crisis will happen. The question is, when it does, will we be ready? If this story made you think, hit that subscribe button. We're exploring more economic disasters that shaped our world.